So you've got some cash saved up and you want to put your money to work in the market. But if you're new to this, you're probably wondering to yourself, where do I even start? Guys, I got you. My name is Oleg, I'm an accountant, and this video is going to be your ultimate guide on how to start investing in the stock market as a beginner. I'll break this video down into 5 separate sections, and here's what we'll cover. First, we'll look at why invest and why choose stocks. Then I'll cover what to buy as a beginner. Then we'll look at when, where, and how much to invest. And after that, I'll do a live walkthrough of actually buying a stock. And finally, I'll cover some common investing questions as well as taxes. And I'll have timestamps down below in the description so you guys can follow along as needed. Now, if you're ready, let's dive in. So why invest in the first place? Well, when you have some extra income, you basically have 2 options for what you can do with it. You can save it or you can invest it. The problem with saving though is that your money loses value every single year because of inflation. So that burrito that cost $6.50 in 2019 now costs $10.70 in 2024. And it's not just burritos, it's rent, healthcare, gas, basically all the things that we need to survive, they cost more with every passing year. And the salaries and wages that people are earning aren't always keeping up with these rising prices. Investing is what helps you level the playing field and grow your money faster than inflation can eat away at your purchasing power. But why go with stocks over other investments? Well, that's because stocks are one of the most accessible ways to invest your money. First, they're traded on public exchanges, which means you can buy and sell them with just a few taps on your phone. And you don't need a lot of money to get started. Stocks are also heavily regulated, meaning that the companies on the stock market are required to produce audited financial statements and give quarterly updates on how they're doing. And finally, investing in stocks is one of the few ways that you can truly passively invest your money thanks to index funds, which we'll cover a little later in this video. Now, when you buy a stock, you're buying a piece of ownership in a company. So if you buy even 1 share of Apple stock, you've now become a part owner in that business. And there's 2 ways you can make money with this purchase. First is through price appreciation. So let's say that Apple does spectacularly well over the next 5 years. Sales are good, its margins are fantastic, and its future looks bright. Then its stock will very likely go up from when you purchased it at. And if you decide to sell your shares at that later date, then you can lock in your profit. Now, some of the more established companies, they also pay out dividends. And that's the second way you can make money from stocks. A dividend is when a company distributes some of its profits to its shareholders. So if a company pays $1 per share each year in dividends, and you own 1,000 shares, then you'd receive $1,000 annually in dividend income. And over time, dividends can turn into a fantastic source of cash flow as you grow your portfolio. Alright, so now what do you buy as a beginner? Well, when it comes to buying shares, there's over 4,000 public companies in the US. So the question that comes up is, which ones do I buy? Most people are going to gravitate towards the companies that they already know. So it's going to be the companies that they see in the headlines, the ones whose products they always use, and the ones that their family and friends are always talking about. But just because a company is popular today doesn't mean it's going to stay winning 10 years from now. And you'll hear this saying very often in investing. Past results are no guarantee of future success. So just look back a few years. In the late 2000s, BlackBerry controlled nearly half the US smartphone market. And at its peak in 2008, BlackBerry stock traded close to $140 per share. But then Apple launched its iPhone and everything changed. By the end of 2013, BlackBerry's stock price had fallen to under $10. Same thing happened with Blockbuster. In the late 1990s and early 2000s, it was the king of home entertainment. By 2010, it was filing for bankruptcy after Netflix started taking its market share. So just because a company is popular today doesn't mean it's going to stay that way in the future. So how do you reduce that type of risk in your own portfolio? Well, some of the best investors in the world recommend taking out the guesswork entirely and just investing in the entire market. And you do this with index funds. So let's break it down what they are piece by piece. An index is just a way to track a piece of the market. So one of the most popular indexes that's out there is the S&P 500. It tracks the 500 largest publicly traded companies in the US. And together, these companies account for nearly 80% of the US stock market's value. Now, if you want to invest in the S&P 500 index, you don't want to go out and buy 500 individual stocks one by one. So that's where funds come in. A fund is just a pool of investor money that's put to work towards a specific goal. So in the case of S&P 500 index funds, that pool of money is invested in such a way that matches the composition of the S&P 500 index. And when you buy a share of that fund, you're buying a share that represents a small piece of ownership in all the companies that make up the S&P 500. Now, when you follow this strategy, you're not betting on any single company to be a star and to win big. But at the same time, you're not concerned if a handful of companies does poorly. Your performance is going to match the performance of the overall market. Vanguard, Fidelity, Charles Schwab, State Street, and iShares have some of the most popular S&P 500 index funds that you can invest in. And you can see the stock ticker next to each one that you can use to look them up. So let's look at Vanguard as an example. I'll go to Yahoo Finance and punch in the ticker, and here it is. It's the Vanguard S&P 500 ETF. You can see how much it's selling for at the time of this filming, and down below you can see its performance over a few different periods of time. And if you scroll down a little further, you can see its top 10 holdings. So there's Nvidia, Microsoft, Apple, and so on. And these are owned in more or less the same proportion as the S&P 500 index. Now, one of the most important things to look at in any of the funds that you're investing in is its expense ratio. That's the annual fee that the fund charges for managing your money. If you got $100,000 invested in a fund and the expense ratio is 1%, that means you're paying $1,000 a year in fees, regardless of whether the market goes up or down. And this isn't a bill that you get in the mail. Instead, it's automatically deducted from the fund's returns. So the lower the expense ratio on a fund, the more of your money is able to stay invested in the markets. And luckily, index funds have some of the lowest expense ratios around because all they're doing is tracking what the rest of the market is already doing. This one from Vanguard has an expense ratio of just 0.03%, which is about as low as it gets. Now let's look at when you should start investing. You want to make sure that you set up for today before investing for tomorrow. So the first thing you want to do is make sure that you have an emergency fund set up. That's at least 3 to 6 months of necessary expenses that you put aside to keep you afloat for when life goes off the rails. And you want to keep this money in a high yield savings account where it's liquid and stable. So basically, you put this money aside and forget about it unless you need it for a rainy day. Step 2 is to pay off your high interest debt. So that's your credit cards, payday loans, or other debt that's charging you 8% in interest or more. And here's why. Over the long run, the S&P 500, through all of its ups and downs, has averaged roughly an 8% annual rate of return. But let's say that you also have credit card debt outstanding that's charging you 20% in interest every single year. Well, if you decide to invest while you have all that debt that you have to pay off, then your debts are going to be growing faster than your investments can keep up. So it makes sense to pay off this debt first rather than have it working against you. And when you're paying off all this debt, you're basically giving yourself a guaranteed rate of return, because every dollar in debt that you pay off today is one less dollar that you have to pay interest on tomorrow. And once that weight's off your shoulders, then you can confidently start investing for your future. At that point, the next question that you have to answer is, where do I hold my investments? So you'll have to choose a brokerage to work with, and your brokerage is going to serve as the bridge between you and the markets. So let's say that you decide to buy some Apple stock. You'll submit your order through your brokerage, and then they'll handle that transaction behind the scenes so that that stock can show up in your account. Some of the biggest names in the US are Fidelity, Vanguard, Charles Schwab, and Robinhood, but there are many others. Here's a few things you want to look for when you're choosing a brokerage. So first, you want to look and see that they're charging either low or no fees when you're buying and selling investments. You also want to see that they have good reviews for their customer service in case you ever have to reach out to them and ask questions about their platform. And you also want to see that they have a friendly app and user interface. So you want it to be something that's beginner friendly and intuitive to use. Now, once you settle on a brokerage to work with, you'll have to decide what type of accounts you're going to open with them. If you're investing for retirement, then start by looking at the different tax advantaged accounts that are available to you. So that would be your 401k and your IRA. A 401k is usually set up on your behalf by your employer, and then the contributions that you make into that account are going to be managed through the investment provider that your employer selected. An IRA, on the other hand, is a type of retirement account that you open for yourself through the brokerage that you decided to work with. The big advantage of both of these types of accounts is the tax breaks that they offer. With a 401k and traditional IRA, you can deduct your contributions from your income today, and your investments, they grow tax deferred, meaning that you don't pay tax on the growth until you're ready to withdraw your funds in retirement. Then you also have your Roth IRA and Roth 401k accounts. And these Roth accounts, they basically flip the timing of the tax benefit. So you invest after tax dollars, meaning you don't get a tax deduction now, but everything you earn and withdraw in retirement is completely tax-free. These retirement accounts are built to reward long-term investing, either by deferring when you'll pay your income taxes or eliminating them altogether. But they also come with one big catch, and that's that if you withdraw your funds prior to age 59 and a half, then you'll get hit with penalties. Now, if you want to have more flexibility, meaning you want to access your funds at any time, then you'll want to open a regular brokerage account. It doesn't come with any special tax breaks, but you can buy and sell your investments freely, and you can withdraw your funds without paying a penalty. The only thing is that you'll pay taxes on any capital gains and dividends that you pick up along the way. So to summarize, retirement accounts give you tax benefits for playing the long game, while brokerage accounts give you freedom and easy access to your money. Most people end up using some combination of both. Okay, now most people get to this part and say, I've got everything set up, but how much do I really need to start investing? And my suggestion is that you start with an amount of money that you can comfortably put away for at least 5 years. And here's why. When you invest for the long term, you start noticing the effects of compounding interest in your portfolio. That's when the returns that you're earning start earning their own returns. So let's say that between your brokerage and your retirement accounts, you're able to put away $10,000 every year, and it compounds at an 8% annual rate of return. After 5 years, your account grows to about $73,000. After 10 years, $166,000. After 20 years, $504,000. After 30 years, over $1.2 million. At the end of those 30 years, you've contributed $300,000, but you've earned over $920,000 in interest. That's what people mean when they say that your returns start earning their own returns, and your money grows in this sort of hockey stick pattern even though you've been contributing the same amount every single year. That's the power of compounding interest. But But here's the most important part. The dollars that you invested in the beginning are some of the hardest workers in your portfolio because they're the ones that spend the longest time compounding. And they're the ones that are responsible for the majority of your long-term gains. So at the end of the day, it's not so much a question of how much you can invest, but how long you can stay invested for. So what I recommend for everyone is to just start as early as possible with whatever money you can comfortably put away, just so you can take advantage of this compounded growth. All right, now let's do an example of actually buying a stock. I use Charles Schwab, so I'll be using them for this example. If you use a different broker, then your interface may look a little bit different, but overall, the process for buying and selling stocks is going to be the same. So let's say you want to buy a single share of Apple. You'd type the company name in this box. So there we go, Apple Inc. And on the screen, you're going to see what it's trading at. Now you want to buy a share, so we'd go to select action and hit buy. Then we choose the quantity, so 1 share. And next, we have to choose the order type. So the most common orders that you'll see are market and limit orders. A market order means that you'll buy the stock at the best price available once your order reaches the marketplace. Limit orders, on the other hand, let you buy the stock at the price that you specify or better. Now, if the stock's price never gets to that limit that you specify, then your order may not go through. So in this case, it's currently selling at about $269 a share. So I'll put a limit order that I only want to buy if the price is $265 or better. And then I'll choose to reinvest the dividends back into the stock, so any dividends that I get back are automatically going to be used to purchase more shares of Apple. And then I'll review the order, and then I'll put it through. Now it's going to be the same exact process if you want to buy shares of an index fund like VOO. So you punch in the ticker, here it is, then the action would be to buy, then you choose the quantity of shares that you want to buy, and again I'll just go with 1. For the order type, I'll go with market this time, and then I'll choose to reinvest the dividends back into the fund because I want to take advantage of that compounding interest, so that's working for me. And then I'd review the order again and confirm it to have it go through. So as you can see, it's a fairly straightforward process. Now, besides S&P 500 index funds, here's a few other funds that you may want to consider. If you want to be even more diversified than just the S&P 500, you can take it a step further and invest in the entire US stock market through Vanguard's VTI. And if you want to go global, then you can take a look at Vanguard's Total World Stock ETF. This gives you access to both the US as well as international markets, so basically the entire global economy within a single fund. Another popular option is Invesco's QQQ ETF. So this one tracks the NASDAQ 100, which is the 100 largest non-financial companies on the NASDAQ exchange. So this ETF is very heavily weighted towards tech, so you'll see names like Apple, Microsoft, and Nvidia in it, and that makes it more volatile, but also gives it higher long-term growth potential. And then if you're looking for income, then Schwab's SCHD is a very strong option. It focuses on quality US companies that have consistent dividend payments. So it's great for investors who are nearing retirement or anyone looking to get cash flow in their portfolio. And as always, please do your own research before investing just to see what works best for your unique situation. All right, now let's look at some common questions that people often have before investing. And the first one is, can I just invest in stocks and nothing else? The short answer is you could, but it might not always be the smartest move. Equities are a powerful way to build wealth. And like we saw earlier, they do have that 8% average annual rate of return. So they've outperformed nearly every other asset class over the long run. But that performance came with a lot of volatility. So check this out. The market was doing fantastic in the mid-2000s. But then came the 2008 financial crisis. And the S&P 500 lost approximately 50% of its value from its peak to its bottom. Now imagine if the majority of your net worth was tied up in the market and you experienced that type of drop. Would you be able to stomach that type of loss? Most people said no, and they sold out of the market at the worst time possible, when it was at its very bottom and when the pain was the worst. But here's the crazy part. Right after this terrible recession, the US entered one of the longest bull markets in its history. From 2009 all the way up to 2020, the S&P 500 rose roughly 400%. And over time, the pattern is clear. Every major market crash in US history was eventually followed by a new all-time high. So if you're young and you plan on staying invested in the market for several decades, then sure, you can ride out the swings. But if you're in your 50s or 60s and you're thinking about retirement, then you don't want to see your portfolio going up and down like that. That's why it's important to structure your own portfolio around your own tolerance for risk, or how much volatility you can realistically handle. And one simple way that investors do this is by adding bonds into their portfolios. Think of a bond as a loan. So you lend money to either a government or a company, and they pay you interest in return. Stocks and bonds often move in opposite directions, so when stocks fall, bonds can help cushion the drop. And when you own both in your portfolio, then it can help smooth out the volatility that you'll feel when you're invested in the markets. And one very simple way to find a good mix of stocks and bonds to invest in is to look at target date funds. These are funds that automatically adjust the balance of stocks and bonds in your portfolio the closer you get to that target date. So for example, if you're in your 30s and you invest in a 2050 target date retirement fund from Vanguard, then it'll start off being heavily weighted towards stocks. so that it gets that aggressive growth in the beginning. But as the year 2050 gets closer, then the fund automatically adjusts its balance so that it's more tilted towards bonds, so that your portfolio is less volatile as you're reaching retirement. Target date funds are one of the simplest and most popular ways to invest for the long term, and you can find them in just about any major brokerage. Another question people have is, what if I invest at the wrong time? Now, we've all heard the saying, buy low, sell high. It sounds like simple advice, but in reality, almost no one actually does that. People often wait for the perfect moment to invest, saying things like, the market's too expensive over here, or everything's crashing, let me wait for the dust to settle. But here's the problem with that. Nobody actually knows where the top of the market or the bottom of the market is going to be. And if you find yourself sitting on the sidelines, then you could easily miss out on some of the biggest gains that the market can give you. JP Morgan looked at the performance of a $10,000 investment in the S&P 500 from July 1st, 2005 until June 30th, 2025. If you had stayed invested in the markets through that entire 20-year period, then your investment would have grown to over $66,000. But if you had missed just the 10 best days in the market, then you would have had just under $30,000 in your portfolio. That's just 10 missed days. And if you miss even more of the best days in the market, that number shrinks even further. So that's why timing the market is a losing game. So what do you do instead? Well, you take timing out of the equation altogether and you invest using dollar cost averaging. Here's how it works. You invest a fixed amount of money at regular intervals. That's weekly, monthly, maybe with every paycheck, and you invest no matter what the stock price is doing. When share prices are rising, you buy fewer. When prices drop, your money buys more shares. And over time, your purchases average out into a steady blended cost, because you were buying both when the market was at its top as well as when it was at its bottom. But even more important than that, it incorporates discipline into your investing because it has you investing in the markets regardless of how they're performing. Alright, now we have to cover taxes because they're going to be one of the largest expenses that you face as an investor. And I don't want you to get hit with a surprise tax bill at the end of the year that you didn't see coming. Now in this section, I'm specifically going to look at how you're taxed on your regular brokerage account. If you're investing through your retirement accounts, like your 401ks and your IRAs, then I'll have a separate video linked down below that you can go to. And that's going to go into a little bit more detail on taxation for those retirement accounts. But for your regular brokerage accounts, there's two main ways that you're going to be taxed. First is through capital gains. That's a tax that you pay on the profits that you make when you sell an investment for more than you paid for it. So if you bought a stock for $100 and later sold it for $150, then that $50 profit is your capital gain. And if you sold that stock within a year of buying it, it's considered a short-term capital gain and it's taxed like your regular income. In 2025, the highest tax bracket goes all the way up to 37%. So those short-term profits can get expensive quickly. But let's say you held that same stock for longer than a year before selling it. Then that becomes a long-term capital gain, and those get taxed at much lower rates of 0, 15, or 20% depending on your income and filing status. So even the government is basically rewarding you for being patient and holding your investments for the long term. Now the second way that you're going to be taxed is through the dividends that you receive. When a company pays you a dividend, the IRS is going to treat it as income, but not all dividends are going to be taxed the same. They'll fall into one of two categories, either ordinary or qualified. Ordinary dividends are taxed at your regular income tax rates, just like your paycheck. Qualified dividends, on the other hand, get the lower long-term capital gains rates of 0, 15, or 20%. The IRS decides which bucket a dividend falls into based on a set of rules and holding requirements. The good news is that most big US companies, including those in the S&P 500, pay qualified dividends if you meet those basic holding requirements. Now there's a lot more nuance here than what I covered in this short section, so please talk to your accountant for more specialized advice. But this should give you at least a baseline understanding of how taxes work when it comes to your investments. So guys, thank you so much for watching. If you enjoyed this video and it helped you out, make sure you leave a like and subscribe to help support the channel, and make sure you check out this video next on the paycheck routine that you can follow to help you build your wealth.